Welcome, everyone. My name is John Vance, president of Vance Wealth, and we have a great topic tonight on taxes. So I know that's maybe a not such great topic, but it's an interesting topic. And one of the things that I just wanted to kind of throw out there before we start is, from a tax perspective, I think we all realize that taxes are a necessary part of running our country from a government perspective, whether it's state, local governments, whether it's federal governments, and all the programs that are supported. What we're not going to get into today is really the conversation of could our tax dollars be spent more wisely? I think we all would agree that yes, they can. The difference is we have opinion on what side of the aisle, I guess, depending on where we sit, where we think those tax dollars could be better spent. And so, today we're going to talk about just a little bit of just taxes 101, going through the basics of taxes, a little bit of just education. Some of you, this is going to be totally review at the beginning, but hopefully it'll just kind of remind you of how some of these taxes work. And then we're going to get into some of the policies. And then I'm going to wrap up with a kind of a case study, a little bit of an example of a tax planning strategy that, that we implemented on an ongoing basis. And so it probably doesn't surprise you. I am much more of a limited, in full disclosure, I'm much more of a limited government, kind of lower tax, pro-growth of a mindset. I'm sure that doesn't surprise many of you. I do believe that individuals, businesses, nonprofits can actually allocate money much more effectively than governments can. And so I think that at the end of the day, I'm a better, I think individuals are better suited to, you earn your money, you keep your money, or you keep a large portion of it, and then you spend it as you see fit, whether it's going to your family, whether it's going to your business, whether it's going to your local community. But obviously we have to pay taxes, right? So today we're going to go through some of the basics. And so I hope you enjoy. What I'm going to do now is share, but and I'm going to try to keep it as, I guess, apolitical as one possibly can. So I would just kind of caution, if you're asking questions, I do want questions, but I don't want this to get into kind of a ranting session. I guess maybe that's the beauty of having some controlled Q&A, because I know this topic is definitely can be a heated one. So let me share my screen and get started. So let's see if I have any issues here. I'm working on a Mac here, so sometimes this can be a little bit more challenging. Okay. So hopefully this is good. Tara, unless I hear from you, I'm going to assume that you can see everything here. So, all right. So disclosures real quick. Let's get this thing advanced here. Okay, we got it. So obviously, Vance Wealth is a registered investment advisory firm, and these are my opinions and the opinions of Vance Wealth only. We're not going to get into really any market conversation today, so it's going to be strictly around these tax conversations. So I'll let you read more. So taxes, let's kind of jump in. So we're going to go through and just kind of break down some basic taxes. We're not going to cover all of it. I'm going to cover some of the high level ones, and I'm primarily focusing on these because these are how they impact your daily life, how they impact your investments, and then also some of the kind of the conversations that have been coming up in Washington about what changes should be made from a tax perspective. And so number one, we're going to start with this capital gains tax, right? So capital gains tax is what an investor pays on the growth of their investments, right? So a capital gains tax is paid when you buy a stock and it goes up in value and you sell it. When you buy a mutual fund and it goes up in value and you sell it. When you buy a piece of real estate and it goes up in value and you sell it. So that's what's known as a capital gains. And then you have to pay tax accordingly. So it's only on a realized transaction, which means it has to be sold. There are no capital gains taxes on unrealized gains, which means something went up in value, but you did not actually sell it. So there are two types of categories when it comes to capital gains. You have short-term, which are assets that are held less than 1 year, and you have long-term, which are assets that are held for greater than 1 year. So a short-term capital gain is taxed at ordinary income. And so you should all know that there's 7 brackets. You have brackets that go from 10% all the way up to 37%, and there's a bunch along the way. So when you have a short-term capital gain, you pay tax based on your ordinary income. So depending on what bracket you fall in, that's where you're going to pay tax at that level. Long-term capital gains are going to be taxed in essentially 3 different brackets. You have a 0% bracket, for lower income. Then you have 15% bracket, and then you have a 20% bracket. Most people fall into that 15% bracket, but as a higher earner, north of 400,000, you're going to fall into that 20% tax bracket. So that's the capital gain tax. We've pretty much had capital gains taxed a little bit more favorably than wages, than earnings, pretty much, since I can remember, and kind of going back in our history, because as a capitalist nation, we value capital creation, which creates businesses, which creates jobs, which creates economic activity. So there's a place to have some favorable capital gains rates, which is what we have in place right now. And so you can see some of the notes on the screen. The next tax that we know, and I have them a little bit mixed up in here, but in terms of they're not in any particular order, just things that are on the docket for potential changes. So you have Social Security tax. So Social Security is taxed that employees and employers pay, and then these are collected through payroll generally. And this is what goes to pay for basically the Social Security Trust Fund. And the current rate of that tax is 6.2% for employers, 6.2% for employees, and that's capped at $142,800. So you pay tax all the way up until that threshold, and once you exceed that $142,800, you no longer pay into that. And the reason why that's in place, the cap, is that Social Security, when you pay into it, you get a benefit on the back end. And so Social Security benefits, as most of you know, are capped. It's not unlimited. So if you work as a teacher, as a firefighter, as a policeman, based on the amount of money you work and the amount of years, you can make higher and higher and higher levels of income. Social Security doesn't have that. Yes, you can make higher level amounts in Social Security, but it's not unlimited. It gets capped. And so that's why they put a wage cap, because they know the benefits aren't going to increase over time. Then you have a Medicare tax. So this obviously is to fund Medicare. And so if you look at the bottom, it says that the current rate for Medicare is 1.45% for employer, 1.45% for employee, and there's no wage-based limit. So this basically goes on forever. So you make $100,000, $1 million, whatever that might be, this Medicare tax continues to get paid. Now, this is only on wages. So in retirement, you do not pay into this Medicare tax unless you were deemed a high income earner. So if you see at the bottom, it says additional Medicare tax on wages over $250,000 for married filing jointly, or over $200,000 single, you pay an additional 0.9%. This was put in place to help fund some of the provisions in the Obamacare healthcare plan. And so essentially this is a tax on wages, not on, you don't pay this, the 1.45 on either side, unless it's from, again, from payroll. So a couple quick things we'll go through. Property tax. We all know what property tax is for. It's paid on real estate and other types of property. This is one of the principal sources of income for local and state governments, is property tax. The other big tax for local and state governments is sales tax, right? So, that's obviously, we understand what sales tax is on goods and services that we purchase. And you can see LA County sales tax is 9.5%. And our, traditionally in California, our property taxes are, around 1%. So that just gives you kind of a breakdown. Those are the easy ones. I think we all know that. And then at a really high level, because the estate tax conversation can get complicated, and I'm going to come back to this a little bit later, but what is estate tax? Estate taxes are taxes on a person's assets after death, right? So this could be called a death tax, an inheritance tax. The federal estate tax currently is at a 40% rate. So whatever you leave to the next generation will be taxed at a 40% rate. However, they do have a provision in place that this is not designed to kind of hit everybody. So there is an exemption level. Currently, it's at 11.7. This year it might have gone into 11.8. So it's around 11.8, 11.7 million per individual. So 11.7 for individual, and then you double that if you're married. So that's the exemption amount. So you pay 40% tax anything above those amounts. So clearly, if you have a large estate, you're going to owe some taxes. If you have an estate as an individual below 11 million, which is a healthy size estate, you will not have any inheritance tax. California currently does not have estate or inheritance tax. There are some proposals that might change, but currently that's not in place. Then there's also a provision, and I know I'm kind of going through this fast, but it's a little bit of just, again, taxes 101. There's something known as a step up in cost basis. And so I'll give you a quick example. So let's just say, many people who've been in California for, over 50 years potentially purchased a house in, let's say, the 60s, maybe early 70s, and homes today that are maybe selling for $2 million, when we go back 50, 60 years ago, we're maybe selling for 30,000, 40,000, 50,000. So if you are a child of someone who passes and then leaves you their home, let's say they paid 50,000, and at their date of death, it's now worth 2 million. Built into the tax code is what's known as a step-up in basis, which means the date of their death becomes the new value. So if you, as the beneficiary, then go sell it, you will then be selling it at that step-up in basis. So for example, your parents paid 50,000, they passed, it's now worth 2 million, you sell it the next day, and because it stepped up to 2 million and you sell it for 2 million, there's zero taxes owed. So that's what's known as a step-up in basis. And the step-up in basis applies to real estate, it applies to stocks, it applies to mutual funds, ETFs, all those types of investments. What it does not apply to, which is really important, it does not apply to IRAs, 401ks, qualified retirement plans. It just does not apply to those. So step up in basis is obviously a really valuable tool because it allows the next generation to basically liquidate assets. Maybe they don't want to live in the parents' house, they want to liquidate the assets, and then they don't have to pay much, if any, taxes because of the step up in basis. So that's a bit of a breakdown just of kind of some of the typical tax issues that you should be aware of. So what we're now going to jump into is just talk a little bit more conceptually around taxation, who pays the taxes, and really kind of get into the weeds on some of these areas. So this is a breakdown. So this is from 2019, basically shows kind of the whole pie of the taxes that were collected in the United States and where those dollars came from. So you can see the largest one on here is individual taxes. At 41% of all tax receipts come from individual taxes, right? So that would be federal income taxes. The next biggest one is social insurance taxes, which essentially we talked about is Social Security and Medicare. So that's about 25%. So another big substantial part of this. Consumption taxes, right? So these are taxes based on consuming something, and then property taxes at 12%, and then corporate taxes. And so what's interesting right now is look at how small corporate taxes are. And I know, there is a proposed change on corporate taxes, but remember this slide because, individual income taxes make up a big part of this. Corporate taxes do not, in terms of current collection. So the chart we just looked at was where do the taxes come from? And then this next one is, well, where do we spend the money? Where does it go? Now, pretty staggering numbers. We look at some of these percentages. So major entitlements, so Medicare, Medicaid, and other healthcare is roughly 28%. Social Security is roughly 24%. What's known as income security, which is basically just other welfare programs, is 17%. National defense is 15%. And then 7% is net interest. So the interest expense to actually run our government. And then 9% is all other, right? So it's pretty remarkable. And I think that's one of the things from a demographic shifts. We know we have an aging population here in America. So I think one of the concerns is as we age, what's going to happen? We're going to have additional Medicare costs. We're going to have additional Social Security costs, and we're going to have additional net interest costs, right? Because we continue to borrow money. So that's a challenge with our current budget. This one's dated in 2017. Try to get as much relevant information as I could, but this data stays pretty consistent. Now, what you are going to notice as we transition to the next slide is these percentages don't hold exactly true as we look at our 2021 budget. And the big reason is because we're borrowing so much money to deal with our current budget issues. So this basically breaks out a proposal for our 2021 budget. So if you look at that budget, we are looking at the total spending column. And then that's on the left-hand side, or technically it's right in the middle. And then on the right-hand side, it shows sources of financing. So obviously this is pretty staggering. So look at our borrowing number. So essentially in 2021, it's projected that we are going to be borrowing half of the money that we're spending, which is crazy. I don't believe that's ever happened. Probably, maybe going back to some times during the Great Depression, leading up to World War II. So you can look at kind of where that money is being spent. You have a big other category. A lot of that's going to come through some of the stimulus programs that we're seeing. And we all know those stimulus have been in the trillions of dollars. So you can see this other line item is around $2 trillion. And then you can see net interest is the next one down. Let me get a little, whoops. Sorry. And then you look at non-defense discretionary spending, defense spending, Social Security, Medicare, Medicaid. So there are some consistencies, but then if you look on the right-hand side, you look at the income that's generated from taxes, you look at the corporate one is pretty minimal in here, only about 2%, about 164 billion. Social insurance, again, those are Social Security and Medicare, and then the borrowing. I think the borrowing is what makes everyone nervous because we know as individuals, we can't just borrow in perpetuity. Government's a little bit different animal because, you know, they do have a lifespan that's essentially infinite. And so they have some ability to borrow with a different mindset than we do as individuals. But clearly that level of borrowing is concerning and should be concerning for everybody. When we start looking at I wanted to give you some perspective on the federal budget surplus and deficit and look at some of the history. So this does go back to 1990. And if you look, for the most part, except for a period in the late 2000s, and you can kind of see this down here. I do have my mouse kind of going over it. In 2000, we did have some surpluses here. This was at the end of the Clinton campaign. This was kind of at the end of the dot-com bubble where stocks and capital gains were quite strong. So we had really good receipts there. But then you can see, I mean, for the most part, we've been running deficits, smaller deficits most of the time, except for you can see here in 2020 and 2021, pretty massive. And, you know, given COVID, given the response to COVID, for 2020, I think that you know, it makes a lot of sense. 2021, I know there's a lot more debate right now around is this amount of stimulus needed? Are we getting back on track? Should we start pulling some of that back in as we start to reopen? And that's kind of a hotly debated political issue. But clearly, I think we all can recognize that the economy is on a mend as we reopen. That's going to help things move along. So, you know, the simple fact that we did have to borrow a lot of money last year and we ran a massive budget deficit to kind of curb really a depression likely if we had not put that in place isn't necessary going forward. Well, this year we're going to spend it, but then you can see we do normalize this in future years. So this kind of settles in. We're still running a deficit. It doesn't improve itself. But it's not at these high levels. And then the one stat that oftentimes you'll see kind of economists talk about is this whole idea that, you know, we can get fixated on the amount of debts when it comes to dollar amounts because they're getting bigger and bigger and bigger. But really what economists look at is what is the debt relative to the percentage of the GDP. And the reason why this is relevant is it's very much like you as an individual consumer, right? So if you buy a house for $1 million and you have a $4,000 a month mortgage payment, well, one of the nice things with a mortgage payment is what? It's fixed, likely for 30 years. So presumably you buy that $1 million home, over time, you're going to be making more money, right? So your income should be going up annually, right? So, and you have this payment fixed here. So 10 years from now, when your income is maybe gone up by 50%, your house payment is a lot less. And so that's what is relevant with this chart is it's looking at percentage of GDP, and GDP is kind of like thinking about your own personal self as your own personal income. So if the debt relative to the size of the economy continues to grow, that's a troubling sign. We know the dollar amounts are going to grow because of inflation and just because of that simple fact. But if one of the goals needs to be for this administration and future administrations is we got to get this percentage of GDP to really start to plateau and come back down. And if you look at where we are in 2021, you know, we're at a pretty staggering number. I think this will put us at a higher level than basically post-World War II America, when we really got back to work, got the factories back open after the war. So that was a time that was necessary to rebuild. And then you saw, obviously, the percentage of debt relative to GDP plummeted until back in the 70s. And so you can see, you know, that's going to be something that I think policymakers will need to focus on, is leveling this off and hopefully starting to bring this down. Because once you get these numbers where it's in excess of 100%, 120%, 150%, what happens is the debt is so large that it's hard to get out from underneath that. And I think that's one of the biggest concerns. And we're kind of getting there now where, I've been having these, doing workshops for everybody, the last several years, we've been hovering around this 80%. And now with COVID, we've spiked up here. So the key is going to be, how do we get this back down? And that's going to be an important component of policymakers. Unfortunately, and I'll go through this a little bit towards the end. Unfortunately, I think both parties, most politicians, they're not really focusing on spending. It's kind of like a blank check for everybody, just spend, spend, spend. Right now, we're bickering on tax policy and where the money should come from, but the money, it's kind of like a free game to just spend what we want. And part of fixing our deficit is going to be around fixing the spending issues as well, not just tax policy. So tax policy might solve some things. Spending restraint and having some more consistency with our spending plan will probably fix more, at least in my humble opinion. So hopefully you guys can follow along with me as I go through some of these Biden proposals. Now, these are just proposals. Now, hopefully you guys all know me as a pragmatic thinker, right? So I'm not an alarmist. I think that what's happening with the tax proposals is that Biden and the Democrat Party have agendas that they want to move forward, which is normal. That's what political parties do. And I personally think that when I looked at all the changes that they're proposing, is they kind of went to the extreme of saying, you know what, we're going to propose a corporate income tax change, an individual income tax change, a capital gains tax change, and a state tax change, all of these things. And we're going to kind of get all the way out to this extreme so that as we start negotiating with the other side, we can kind of come to some agreement in the middle. So I don't think they started small and wanted to negotiate small. I think they started big and they're going to negotiate big. That's my personal opinion. Now, there's probably not a necessity for that because of the control that they have, basically in the House and the Senate and in the White House, clearly. But that's kind of my expectation. I also know that in looking through a lot of these, a fair amount of these policies are not popular with the Democrat Party. So even though this might be a way of creating a little bit of alarmist mentality with a lot of taxpayers, we'll see what happens. Now, nothing would surprise me. It wouldn't surprise me if a lot of this got passed. There are some things that I'm kind of okay with. There's some things that I'm really not okay with. So I'm going to try to unpack some of the issues and make sense of them. So that's really my goal. It looks like we had a question come in. I'm just going to check it real quick and just see if it's relevant for our conversation right now. Where did my mouse go? Oh, it says I have a lot of echo. Okay. Well, that's helpful. Don't know why that is.
John, you're good on my end.
Good on your end? Okay. Oops. All right, I got to close out of this. Sorry, everyone. Okay, and I'm a rookie. Usually I use a PC. I got an Apple over here and I'm pushing buttons. So, okay, so let's talk about some of the issues. So first one we're going to deal with is the corporate income tax rate. So part of the Trump tax proposal, or tax changes, excuse me, was to move corporate income tax rate down to 21%. And the proposal is to bring it back to 28%. Now, you can see my notes that I have on here in the gray. So we're going to follow a very typical pattern. I have 4 slides here that we're going to go through, and we're going to go through the current law. We're going to go through Biden's proposal, and then we're going to go through a Vance wealth opinion / potential impact. So in the blue, it's going to be the current. In the green, it's going to represent Biden's proposal. And then in the gray boxes on the right, it's going to kind of give my opinion around what do I think this means. And so as we start looking at this proposed change with the corporate income tax law, I do look at this as mostly a political decision, right? Because when you looked at how small the amount of corporate taxes, depending on what chart we looked at, it was somewhere between 2 to 4% of all income tax receipts. And so it's kind of a political hot button, and it's very popular. It's a populist conversation to say, you know what, corporations should pay more money. And that's become a very popular chant. So I think it's a political decision. Frankly, by going from 21 to 28, it's not going to really move the needle. It's very minimal from a tax receipt perspective. One of the things that it will do from an investor perspective is it will impact corporate earnings. So when companies report their profits and they do like an earnings per share, generally those are going to be reported as after tax. So they're going to be post-tax. So it will have a negative impact on corporate earnings, just like a few years ago, it had a positive impact on corporate earnings. So there could be, by some measures, and this is not my opinion, by some measures, if they made this change on corporate earnings, it could mean the stock market is overvalued by like 10%, because now earnings are going to come down. So based on this tax change. And so there is a potential impact on the stock market. If this does pass, it's not a necessity that it has to go down, but there is that argument that if earnings go down, then it makes the stock market might need to come down in conjunction with, that would be similar to this tax increase. The other thing is, looking at, there might be a potential boost to international stocks, right? So one of the things that happened, and we've been overweight in the US, but one of the things that has happened is in the middle of COVID, we added some more US holdings because we looked at this and we knew our tax policy was going to help kind of push us out of here. And if this reverses back, there's going to be other places around the world that might have more effective or lower effective tax rates, which might make them more competitive. And that's where capital might go to. So corporate income tax rate, again, I think it's mostly political. I think that it's going to have some impact, but I don't think it's going to move the needle as some of these other ones. And frankly, other than maybe a reset of some of the pricing in the stock market, it doesn't impact you individually. And really, this is kind of going after the big companies of America. So let's look at the next one, individual income tax rates. So the current law, or current highest tax rate is 37%. The proposal is to go back to pre-Trump tax cuts and take the individual tax rate to 39.6%. Again, I think this is mostly a political decision. I think it's kind of Biden's taking the approach, which I can't really disagree with, of like, hey, our economy was working fine under that tax regime. We need more tax revenue because of all the stimulus. And so that seems like an easy one just to go back. It's not a huge increase to the average, even high earners, at 2.6%. It does mean real money, but it's not a giant change. Again, minimal tax receipts. And I think this comes back to this idea of pay their fair share, which I inherently have a huge problem with this idea of fair share. And I'm going to go through, I have a few slides to really discuss this. This is probably where we'd have a really lively conversation, but this idea of fair share, I'm going to try to unpack that and really kind of dig into, okay, what is the fair share and how do we define that? So again, these two issues, I think these will both pass. I think these are probably the low-hanging fruit. Again, very popular politically, but tax receipts wise, fairly minimal and modest impact on the economy. Okay, now we have some biggies. So capital gains. So right now, the highest capital gains rate, and I don't have the code in front of me, but it's somewhere north of 400,000. It could be 350, it could be 450, but somewhere north of 400,000. The highest tax rate is 20% federally. And then being in California or whatever state you're in, you have income tax on top of that. So that's the current law, is the highest rate is 20%. And then that's just capital gains. There's also what's called the net investment income tax, which is an additional 3.8% tax on top of capital gains. So technically, if you're in the highest bracket, it's 23.8. So Biden's proposal, which is in the green, is tax capital gain as ordinary income for taxpayers with over $1 million of income. So you can see my notes. I'm probably not being shy about how I feel about this. And so I want to walk you through a little bit of my thought process. And so this is a massive tax increase. So this would take capital gains rate for higher earners from 23.8% to 43.4. 43.4. And that's a 55%. That's a 55% increase. Or yeah, actually, that is a typo. Excuse me. That's over or almost 100% increase in taxes. So excuse me, that's almost a doubling of taxes. If this does pass and it's not retroactive, which means it doesn't apply for 2021 and it applies for 2022 and beyond, we are likely going to have a selling frenzy with people trying to get ahead of this, right? Because if you have stocks, mutual funds, real estate that have large capital gains, you might make the decision, it's not for sure, you might make the decision that says, you know what, I'm going to go ahead and sell this, take my profit, pay tax at this lower level to avoid a future higher tax. So this might cause a selling frenzy with lots of economic activity. It actually could be a boon for the economy, meaning positive for the economy for the 1 year, because it'll create a lot of economic activity, especially in the real estate market. But I think this is bad for the economy long term because of how massive this is. And now many of you might be sitting there and say, hey, this doesn't impact me. This is above $1 million. Well, what happens if you you sell your house? Let's say you've been in Pasadena your whole life and you bought a home for $100,000 and you're in San Marino and now it's worth 4 million, and you say, you know what, I think I'm ready to relocate to a different state. It's time to go. We're gonna sell the house and move. So under current tax structure, you'd pay almost 24% in long-term capital gains, and then but under the new one, it would be closer to 44. So essentially, on those millions of dollars of a home you might sell, you're talking about on $1 million extra, it would be 200 grand of more tax. On a $2 million more, it would be 400,000 of tax. And so the taxing this higher capital gains as ordinary income. I know a lot of us look at that and say, well, $1 million, but if you sell an asset, meaning a house or a stock portfolio, and it's above that number, it can push you into those higher brackets and you pay taxes at that higher rate. So I think this is a bad idea. I don't think that this is, and I'm going to go through a little bit later, just kind of going through our taxing and spending policy. I think it's too big of a jump. I think if the agenda is really truly, hey, we got to tax capital higher, I think it needs to be a little bit more gradual, even though I'm not a fan of it. If that's going to happen, I just think this is bad for the economy long term because it's so punitive. And if you're in the state of California, that puts you north of 50% taxes. And think about, we have a lot of baby boomers that are also kind of on the verge of retiring, and maybe they had a business that they've been running for 40 years and they're ready to exit that business. And now instead of paying 24% to feds and 10 or 11% to state, now instead of having a 35% tax liability in total, they're going to be north of 50. And so it really is a game changer, and that's fairly punitive to have taxes when they're in excess of 50%. So that's kind of my overall feeling on capital gains. There's going to be some changes there. I don't know how far this will get pushed because even this one is not popular with both parties. So clearly the Republican Party doesn't like this. I mean, the Republican Party tends to have more low tax, but both parties are not enamored with this because of the size of the increase. Real estate. So there is something in the real estate world called a 1031 exchange. So a 1031 exchange allows you to basically exchange real estate. So if you have an apartment building and you would like to sell it and go purchase another apartment building or a commercial building or something else, you have the option of doing a tax-free exchange. Now there's rules you have to comply with, whether it's equal or greater value, then you can actually do a tax-free exchange. And so if you bought a property 20, 30 years ago and it's grown in value, but you want to change it for something else, you have the ability to do a 1031 exchange, which allows you to then move to a new property tax-free. So all of that money that you've been building up can move tax-free. So the current law basically allows this. Biden's proposal can be used if you had income less than 400,000, but if you had more than 400,000, that you'd be ineligible for this capital gains deferral. So my kind of note on this is, the impact is unknown. I don't view this as a positive because, one of the things you don't want to have is a stagnant, any kind of market, stock market, real estate market that's stagnant. And this could cause people just to hold on longer. And that just cause, it's a economically positive when there's a turnover in property, right? So because a lot of economic activity happens when properties are bought and sold. You have a buyer's agent, you have a seller's agent, you have a bank financing, you usually have appraisals, and you have improvements of properties, and there's a lot that goes on. So turnover of investment properties can create a lot of economic activity. So with the elimination of this, it might cause, it will likely cause less real estate transactions. And so again, the full impact I haven't studied. I don't view this as a real positive one. I think they probably could do some minor adjustments to how they would look at it. But as it stands right now, this just seems like one that's not going to be super popular. And I don't understand the motive with doing this one. So as we get into the next one, Social Security. This is probably my least favorite. So let's talk about taxation of Social Security. Actually, let me do a quick little check-in here. See what kind of Q&A I have. All right, just says I sound fine. Perfect. Okay. So Social Security. So right now, Social Security is taxed to the employer and the employee on applied to wages up to $142,800. right? So that's for wages or self-employment income. That's the current law. Under Biden's proposal, it would be to impose an additional Social Security tax on wages or self-employment income over 400,000. So it would have this weird kind of donut hole, which means up to 142,800, you would have those taxes, and then from 142,800 to 400, you'd have no taxes. And above 400, those taxes would come back. I don't think I'm holding back on my opinion here. You see my first bullet point. This is a terrible idea. I have a video on how to fix Social Security. This is not it. I have probably a half-hour video on how to fix Social Security without causing this level of pain. This is a terrible idea because remember, Social Security is individuals are paying into it to get a what I would call a pension. I know technically it's an entitlement, but you're paying into it all your working career. You don't get that money. You pay into that and you get a benefit. So by taxing additionally on top of this, there's no benefit that comes out to you. So it's just an additional really large tax. So here are the numbers. Now, I use somebody who's making $1 million, that's self-employed wage earner. They're going to pay an additional 12.4% tax. And I know some of you might say, hey, that's not me. I'm not going to be affected by this. But I don't think we all just have the assumption of how we feel about taxes. It's just not about how it affects us. It's just like, okay, is there a fairness to this? Is this an appropriate way to handle tax policy? Is it not always, is it going to impact my bottom line positively or negatively? It's just looking at this from a fairness and from a severity of the tax increase. And so if this changes, the additional Social Security tax for this person would be an additional $75,000 per year of income tax. So in this situation, for a California resident, and this is they're self-employed, which means they might have employees or a small business or they're independent contractor, again, a healthy earner, but their total tax bill would be $528,000. So that means federal 306, state 94, Social Security 92, and Medicare 35. That's their total tax bill. So it's always fun when you start talking about tax rates above 50%, and you start looking at, we have some interesting conversations in my household with a bunch of kids in high school right now, and you start having the conversation that, hey, tax rates aren't quite this high, but you'll get the concept here is, in this scenario, this individual has to work until basically July 1st for the government, and then they work for themselves and their family through the rest of the year. And when you break that down into that kind of a thought process, it starts to hit home a little bit at the impact of a tax rate north. This is an effective tax. This is what they pay north of 50%, meaning you're working half of your day, half of your life, half of your year for the government, and then half for your family. So you get to these really punitive taxes. And, I think this is dangerous for the economy when you get to these, again, really extreme high levels of taxes. So let's see, that was kind of, okay. All right. So next one here that I want to get into. So again, that's a kind of Social Security proposal. Now we're going to get into capital gains and the estate tax. Now, this first one out of all of these, well, Social Security might be unpopular, but I have a feeling this one's going to be the most unpopular. Is this? We talked earlier about this idea of a step up in basis, and so the current law is that you get a step up in basis. Basically, it's a readjustment of the value of an appreciated asset. Again, it could be stocks, it could be a house, for tax purposes upon inheritance. So you get a step up in basis. So you avoid those capital gains taxes. Under the Biden proposal, this will no longer be permitted. Now, this is fraught with challenges. So think about somebody, any of you that maybe had yourselves or even parents who lived in a home for 30, 40, 50, 60 years, right? And you think about what goes into the basis of a house is what you paid for it plus any improvements, right? So can you imagine trying to prove to the IRS, okay, this is what how do you even go back that far to figure out what they paid and then all the improvements? So it's a record-keeping nightmare. We know the IRS is already understaffed. So creating this, one of the nice things about the step up in basis is kind of a clean slate. It just allows people to just have a reset, and then because the basis is unknown in many cases. And so this would be eliminated. I think this is so unpopular with both parties that I think this is one that's going to get eliminated. I just don't see this as a high likelihood event. I think this is really, it gets the the right side, the right of the Republican Party up in arms, and all kinds of nasty messages and nasty articles and all kinds of fear mongering. That's happening right now. I think this is a really, really low chance of passing. And maybe that's me saying, I hope this is a really low chance of passing. Hopefully I'm not just being cavalier about this, but I think it's a bad idea. I don't think this will pass. So the reason why I have these two concepts, so they have a step up in basis, and then you have the estate taxes. So the estate tax exemption right now is really high. So the first basically 11.6 million, or I guess now it's closer to 11.7 million per individual on the fair market value of their assets, basically is exempt from estate taxes, right? So the first 11.7 million, let's call that. And then if you're married, then you double that, right? So it's a pretty big number. That's north of 23 million. And then anything above that, you have a 40% tax rate. So the Biden proposal could expand this estate and gift tax by basically reducing this exemption. So the chatter that we're seeing now is reducing this exemption back down to 3.5 million. So that's a pretty substantial reduction. And then changing the tax rate to 45%. Now, the other thing is, because he's considering eliminating the step up in basis, that's where I think this is really dangerous. Like, if we have to pick the one evil that we're okay with from a tax perspective, in my estimation, it's the estate tax. And I know I get into conversations I've gotten into a conversation with accountants and those that, kind of think any tax is a bad tax. Again, I'm not here to kind of vet that and have that conversation, but, my feeling on the estate tax is, I think that if we need to generate the revenue as a nation, the more effective place to tax is at the death, right? Because as an individual, while I'm building a business, I would prefer lower taxes. While I'm spending for my family and providing education and getting kids off to college, I'd rather have lower taxes, so I have more discretionary capital to provide. And then what I have built up with my net worth, if there's some taxes that then go to the government, I would prefer to do it later in life and have full access to my money while I'm still building a business, still building a family. So that's my personal opinion. But what I think in this estimate, so, moving that exemption down to 3.5 million, I don't love it, but it's like, it's not popular clearly with high net worth. If any of you are sitting on this saying, man, I'm in this group, it's not going to be popular, but I don't think it's totally unreasonable. But I think the mistake that's being made in all this is, lower the rate down, lower it down to 25% or 30% or something more reasonable, because what happens is, those with means, get sophisticated estate planning attorneys and find legal ways to gift money, to move money out of the estate so they can avoid this tax. When tax rates get high enough, you incentivize people to find any means necessary to avoid them. And if you make them more reasonable and to a point where people aren't trying to dodge them, kind of accept that as part of being an American, right? We got to pay tax. To what degree, right? Above 50 starts to get punitive. At 20, 30, is that reasonable? And so again, we can debate all those conversations, but we all know we need tax receipts. And it's just like, what's the most effective way to do it? So again, the step up in basis, I really think is a bad idea, because I think it creates a challenge for everyone. This creates a challenge for even more middle income Americans, where they bought their family home for $20,000 and it's now worth $500,000. They have to pay tax on that, right? So again, the estate tax law, if we shift it, I know I have clients it's going to impact, so I don't love that part of it, but I don't think it's totally unreasonable. What I would like to see the tax rate below 40%. I think 30% is more reasonable, because I think it would involve way more compliance, and it's going to be enough revenue coming into the government. Okay, so we're going to transition a little bit. So that's kind of the summary of the Biden tax proposals. So some fairly significant proposals, but we haven't seen any action yet. One of the things, the biggest question I've been getting is this going to apply to 2021 or 2022? And I know I alluded a little bit, but I just want to reiterate, the later we get in the year, the more likely that this applies to next year. Because we're now in May, tax day was just yesterday. I do think the likelihood of whatever changes are made are going to be pushed into 2022, which I guess the good news with that is as investors, we get to make decisions. Like, we can put together a plan given where the tax rates go to have a strategy to make decisions. Should we sell stuff? Should we realize gains at lower tax rates? Like, we'll have some time. If they make it retroactive, we're stuck. We can't do anything on a retroactive, or we can't do anything for this year because it's already going to be too late because they're going to make it retroactive. But I don't think that's going to happen. So part of Biden's American Families Plan is talking about increasing tax enforcement. So I know the dreaded IRS, right? Everybody hates the IRS, no matter what party party you affiliate with. We all hate the IRS. And they're talking about increasing IRS funding by about 80 billion over the next 10 years. And there was a bunch of staggering stats. And I can't really say how accurate these are, just reporting some of the data. But the White House study found that the top 1% of earners failed to report 20% of their income and avoid paying about 175 billion in taxes a year. So some of these proposals is to booster up enforcement so that it really can target larger corporations, larger businesses, and focus on collections. You can see the fourth bullet point down says the average gross tax gap with what was due and what was collected is about 440 billion for several tax years. So I do look at this as a problem. Now, I hate the IRS just like all of us, but if you're going to have tax policy, you want to have a system where when you fall into these tax codes that you pay according to that. You don't want to have a system where people are cheating the system and not paying into it based on how the tax code is established, because then you have those that are taking advantage, right? You have maybe the same earners, one's paying more because they're being truthful, one's not paying because they're hiding. So I do think this is going to be something that's going to be a bigger issue. So from an IRS perspective, especially higher earners, you got to have clean books. You got to do things above board. You got to make sure that you're following the code, because we're going to have more IRS enforcement. Because collection is kind of the easiest place to solve it, right? It's kind of like a business owner. If you have accounts receivable, if you have money that people haven't paid, go collect it. And so I think that we're going to see that. Plus, with technology, IRS is still working off a really old, antiquated system. They get some artificial intelligence and a system that actually work. They're going to be able to spot stuff, in a much more efficient way. So this is a little bit of like a warning of collection enforcement will go up. And we can debate whether, that scares me a little bit, but at the end of the day, and not because I'm doing anything about my taxes, it's just frightening to give the IRS more power, but that's likely what's going to happen. Because we're looking at these gaps that they're identifying where tax is owed and not being paid. And, that's something that we can probably all agree on is like, if you owe it, you should pay it. And we can debate where you should be taxing. That's a different conversation, but you should be following what the law is, again, in my humble opinion. So that's going to be a big force for the IRS, and we all know if you've ever tried to call the IRS, you can't get a hold of anybody. So they do need to improve their service experience and enhance their tax enforcement. So what we're going to get into is I want to kind of finish up with a little bit of I don't want to say philosophical, but this is probably an area where we get into a lot of debate and not necessarily agree on. But one of the big debates that we have that's being debated on the media, which is debated by individuals on a constant basis, is, do the rich pay their fair share? Right? So it's a fair question. And well, let me rephrase that. It's not a fair question, because what is fair? What does fair mean? So fair might mean equal, depends who you ask. If I ask my kids what's fair, it's equal. They think that equal means fair. Now, I don't necessarily agree with that, especially as a parent. We definitely will maybe parent our children different, kid to kid. We try to be as fair as we can, but that doesn't always mean equal. So when it comes to the tax code, how do we define fair? So I think we could look at both of these and say, you know what? Let's identify what's happening here. So the top 1% of earners, so this is the top 1% in America, that means they earn more than $540,000. They earn 21% of all the income. So that's how much they earn as a group. 21% of income earned is to that group, but they pay 40% of the tax. So the top 1%, yes, they earn a disproportionate amount, but the tax owed is a much larger disproportionate share. And if you look at the top 10%, the top 10% has basically earned 48% of all the income. So the top 10% of earners earn 48% of the income, but they pay 71% of all the federal income taxes. And if you look at the bottom stat on here is half of taxpayer pay 97% of federal income tax, and the other half essentially pay none. So that you can look at the bottom 50%, and their share of earned income is 12%, and they pay 3% of that. And so this is a really difficult question, right? I mean, we can debate this. You know, when I look at this and say, okay, we know we have a progressive tax system, which is going to, you know, it's the higher earners are going to pay a higher percentage, and so that's built in. But to suggest we need to keep going more, you know, well, what's the right amount? I mean, there's been some stats that says if you tax the top 1%, 100% of their income, you can't run our federal government. So what I would argue is we're wasting a lot of time around tax policy, and we're spending almost no time on spending policy. And that's, I think, what's dangerous. That's the only way to get out of this. You know, if we don't do a lot of budgeting in the work that we do, but if we sat down with somebody that had debt, we wouldn't be sitting down with them saying, how can we make more money? How can we make more money? How can we make more money? Now, that is a solution that we would like to get to, but where do we start? How do we cut expenses? How do we clean this up? You know, the goal is to make more money, but there's a higher probability that if you cut spending and you're more disciplined with spending, you can improve your budget. We know that at the individual level. Why have we lost our mind and we're not applying it at the federal government level or the state government? And so this fair share thing is going to pit Americans against each other. And when you look at these stats, you know, I think that if we look at this and say, is this fair? I could argue that, yes, this is fair. This is how it should be, because the top 1% are saving a lot more. They're building a lot higher net worth. But the question is, should it go the other way? What should we have the bottom 50% pay no tax? Should we have the bottom 75% pay no tax? At what point do we start saying that this is an okay system? And you know, right now, I think it's kind of been pretty consistent here for several decades, and I don't think this is where things are broken. All right, so welcome to California. We all know we live in a glorious Sunshine State, and we are, you know, essentially the highest tax state. You can see we have the privilege of having a 13.3% highest marginal rate, and that's above $1 million. And then you can see all the other states around. It's no surprise that during the pandemic, people are leaving California. They're going to places like Nevada with no state income tax, Washington with no state income tax, Wyoming, Idaho, Montana, Utah, Colorado, lower tax states. Texas, clearly. So, you know, this is just meant to kind of give you a snapshot of where some of the higher tax states are. I don't think this comes as any surprise. We all kind of knew that. So here is, I think this is going to be, I'm going to end on this slide. I do have a tax planning strategy, but I think I'm just going to do it as a one-off video, and it's called tax loss harvesting. So I'll just do it as a one-off video and send it out just from a time perspective, because we're coming up on an hour. So this is a really important chart. So it only goes back to roughly 1985, but basically what this shows is the blue represents revenues as a percentage of our government, meaning how much money, or sorry, a percentage of our GDP. So how much money is actually coming in relative to the size of our economy. And the red represents the spending, how much is going out. And if you look back here in 1985, you can see, and I have my mouse kind of hovering around it, it was around 18% is where our spending was. And then if you see from 1985 until about 2000, when we actually had a budget surplus for a short period of time, we got close to 20%. And then our spending dropped down to roughly 18%, right? So it kind of flipped. And the reason why that happened is a little bit of an anomaly, but we had a really strong stock market for 5 years. We had a strong real estate market. Our budget was fairly balanced from basically a balanced government, right? We had Clinton as a Democrat president. We had a Republican House. So we had balanced government, and the spending was much more under control. We didn't have wars we were dealing with. It was a quieter time in our nation's history. And you can see we ran a surplus. But if you look at, the blue line, it stays pretty consistent. Our revenues have pretty much hovered between 15 and 20% for as long as we can remember. Now, right now, it's kind of down at this lower level. And you can see right around the 16%. And you can see the spending has spiked. Now, we had some times in our history where the spending kind of had to spike, right? We had spending spike right after September 11th. We had spending that spiked during the financial crisis, and then we've had spending spike during COVID. But when we go through all of this, when we look at the history of America, and you go back, for even a few hundred years back, our revenue and spending have kind of hovered in that 15 to 20%. That's been a very consistent level at the federal level, for the federal government, is to be in that level. And so the conversation around how to fix things needs to be a combination of, okay, is our tax policy smart? because we want a tax policy that also helps grow the economy, right? If we have a tax policy that's negative, then our economy doesn't grow. And part of solving some of these issues, if our economy grows, guess what? Guess what? We collect more in taxes, right? If the economy does better, if I make more money as an individual, I pay more in tax. That's good. I'm happy to do that. So we want the economy to grow. So we need to have a tax policy that is going to be balanced to allow for growth, but also enough to fund our government. But clearly, we got to get control of the spending. So we got to get it back down to 20%. That might be spending caps. We might need to figure out some solutions. And unfortunately, it's a little bit, I guess, troubling to me because no one's having that dialogue. And when I say no one, I mean, we can talk about it, but I don't see it anywhere. This is one of the biggest challenges we're going to face. And until we start dealing with how do we make smart decisions on a go forward basis, we're going to continue to have these conversations. I do think we're going to start having some modest inflation in the economic system. I don't think it's going to be runaway inflation. I think the media is kind of jumping on that. That's been like the headline du jour for the last several months. I think we're going to see some inflation. We're not overly concerned with that at this moment. But again, this is a big issue here. Is we're spending all the time on tax policy, and I think we need to, if we're going to spend time there, we need to spend equal, if not more, time on the spending habits and how we're spending our dollars. So with that, like I mentioned, I'm going to kind of skip through my tax loss harvesting. I will do that as a kind of standalone workshop. And we had participants kind of stick all the way through. So thank you for attending. I hope you enjoyed this. I apologize. I hope I didn't offend anyone. I was trying to be as neutral and balanced. And again, I do have opinions, but I try to be as pragmatic as possible because I think that's the only way to really make a difference and to have a meaningful dialogue. So let me take a look here at a couple of questions. Oh, I have a funny one, John Vance for president. That is flattering, and I know it's a little tongue in cheek, but who wants that job? First of all, not me. But there's a lot of hopefully we can start having our voices heard. I mean, there's a lot of challenges that we have as a nation, and this is going to be one of them. This is a fight that we're seeing constantly being brewed in the media, and I hate seeing it because I think there are some pragmatic ways to address it. But it seems to me that both parties don't really want to play that game. So unfortunately, we are kind of stuck with just as maybe passive observers watching what's happening rather than being actively engaged and hopefully making a difference. So that's why I think you guys have heard me before talk about, my focus has always been on myself, my family, my business, my employees, my company, and my community. If I can take care of all those things that are more localized and make an impact there, then I can live a full life. And I think a lot of this tax policy stuff is a lot of noise, but it does have real impact. It has impact on all of you as investors, and it has impact on your kids and on your family. So hopefully this was enlightening. If we do get some tax policy change, well, let me rephrase that. When we do get new tax policy, I will report back on what's happening, and we'll deal with what did get passed. Right now is a little bit of speculation. So if once I get some data and I know the facts, then we'll come back and we'll have more of a dialogue, and maybe we can do it in person. I know starting in September, we're going to hope to get back to the Pasadena office and maybe do another workshop in person because I'd love to see all of you. So thanks for participating, and have a great night.